Hello, welcome to Market Call. I'm Michael Haynes with in for Andrew Bell. All this week, for this hour, it's David Burrows on the program, President and Chief Investment Strategist at Barometer Capital Management. He's here to take your calls, your emails, your tweets, your video questions on North American large caps. You can call us toll free, 1-855-326-6266. Works right across the country. You send the bill to Andy. You can email us, marketcall@bnn.ca, or follow us on Twitter. But if you'd like to get to the front of the line with a question for your favorite guest, get on the Market Call fast track with a video question. Film it using your smartphone or your tablet. Tag us on social media or send it via email with video question in the subject line. And we'll be sure to follow Andy's rule, which is you get to the front of the line if you decide to put your mug on TV. David, welcome back.
Great to be here.
All right. Big story of the day. Marijuana. You're not interested.
Well, it's not been a space that we've been focused. We're more sort of mid to large cap securities. And we've been more focused in the U.S. Arguably, it would be great to be there because I think that they've had a very good run. But we've been more focused in other industries.
Well, you've had a remarkable run in the United States. Yeah. And it began long before Donald Trump became president-elect. So we got that Trump bump that comes with that as well.
Right.
But with Goldman Sachs up 24%, 3M up 14%, are we not due for a little bit of a pullback?
Look, you know, I'll go out on a limb, and I've had a lot of debate about this recently. We've been bullish all year. We had a view that in June, there was very clear leadership emerged in financials, industrials, energy, and technology. This really hasn't changed other than accelerated since the election. On the other hand, sadly, the most over-owned parts of the market, you know, the bond proxies, utilities, telcos, REITs, the ones that became overly loved, we felt had the highest risk given that we were sort of at 1,000-year lows in interest rates. Now, you can try and get cute here and expect a big pullback. The problem is positioning in the market is way too defensive. There's cash sitting on the sidelines. BlackRock estimates $70 trillion sitting in cash. $180 billion came out of equity mutual funds over the course of the year. And that money is not yet replaced, not even close. So I think that those that are waiting for some kind of 10% correction are going to be disappointed, and I think they're being way too cute. We think that the economy is inflected, and valuations for equities can expand from here.
The economy has inflected. What do you mean by that?
So the slowdown in 2015, those 5 quarters of negative earnings growth, was an inventory correction. At precisely the moment the market got most bearish in February of this year, global PMIs, the purchasing managers, turned higher. Economic indicators started beating expectation. And what was expected to be a 6th quarter of earnings declines turned into earnings gains and revenue gains. And that began a cycle of estimate revisions. Now, realistically, post the election, most analysts are gun-shy about raising their numbers until they see more concrete evidence. The sad part is, as a market participant, you can't do that because by the time it's clear, you're too late.
What do you make of the trading theory that if you follow Donald Trump's tweets, that gives you an opportunity to jump in or out of any given equity depending on who he's upset with or in favor of that day?
Look, there's a lot of different approaches. That's not one that I would follow. You know, there's a lot of great ideas out there, and we certainly don't have a corner on it. But we do have some tools that have been pretty good at recognizing changes in flows for more than a couple of days.
So you're not worried that the big run-up we've seen in U.S. infrastructure stocks, for example, comes way too soon considering how long it takes for infrastructure money to filter down to the bottom lines of these companies?
Look, you know, I would say this. The changes that have happened at the sector level started in June. And realistically, when you look at things like financials, the financials are trading as a group, the banks still below book value. That's without assuming book value can go higher due to higher interest rates and a little bit better U.S. economic activity. They're only paying 25% of their earnings out, you know, relative to the Canadian banks, very low. This is the beginning, not the end. And so I would say you can try and get cute on this stuff. There could be a pullback at any time, but given the positioning in the market, it's not very likely.
Let's take a break and come back with some calls. Got David Burrows here, President and Chief Investment Strategist at Barometer Capital Management. We're talking North American large caps, and if you've got a question, we've got a line available still. It's 1-855-326-6266.